With massive layoffs in nearly every sector, weakness in manufacturing, car sales and housing, and the biggest one-month decline in the trade deficit since the financial crisis, the economic picture is not looking good, which might explain why so many billionaires are loading up on gold, including hedge fund manager John Paulson and real estate mogul Sam Zell. Bottom line, now is the time to own gold, which is why the experts at Stansberry Research just stepped forward with a major gold prediction, arguing gold could soar as high as $3,000 by the end of the year, possibly even higher. You can find out why and get instant access to their #1 gold investment today. It's not bullion, an ETF, or a mining stock, but in the past, this gold strategy could have made you nearly 50x your money. Considering how quickly the price of gold has been moving in recent weeks, you don't want to waste any time missing out on the gains these experts believe are in store for this gold stock. To get a copy of his new free report with all the details, simply go to goldmaniareport.com. Again, that's goldmaniareport.com for a free copy of his new report. Hi, this is Daniela Cambone, and welcome back to the Daniela Cambone Show, where today we are talking de-dollarization, but taking it from the angle of we keep hearing about it, but it never happens. How come? Well, my guest today has an interesting take as to why. Please welcome back Alf Picatello, the founder and CEO behind macrocompass.com, themacrocompass.com. Alf, always good to see you. Welcome back.
Hey, Daniela, nice to be here. Thanks for having me.
So, I'm a big follower of yours, Alf. I know you watch my show, and we've been tracking and talking de-dollarization, and I've really had experts on both sides of this. But I thought your comments recently have been really interesting in regards to it, where you say, look, an orderly unwinding of the US dollar is a fairy tale. There is no valid alternative for a smooth transition, and deleveraging the global US dollar debt-based system would be a very painful process. Talk to us more about your thesis on de-dollarization here.
So the de-dollarization is going to happen, and it's going to be a very painful process. What I always debate is this idea that we can have an orderly transition from today's dollar-centric system to something else. And that we can't have that. So let me explain why. There are two main reasons. The first is that together with the fact that we transact mostly in dollars, 80% of global FX transactions are denominated in dollars today, most of commodities trades are denominated in dollars, and so on and so forth. What we have also done is we have created $12 trillion of debt denominated in dollars, but issued by entities that are not in the United States, Daniela. And what that means is a Brazilian corporate that wants to finance their business when they sell commodities maybe in dollars, they will need to fund and to issue debt in dollars. When they become indebted in a currency that they do not control, they do not have direct access to, they basically become dependent on dollar inflows from their trades to service their debt. So they need to sell more commodities in dollars to pay their dollar debt and their dollar coupons. What happens if they want to try and trade in Chinese renminbi or in Russian ruble, or they want to stay away from the dollar? What happens is they will lose their access to their dollar flows. How are they going to pay for their dollar liabilities? Effectively, the system has been built so that it's impossible to move away from the dollar without it being a very painful process. That's the first line. And the second is, what is the alternative in terms of investments? Because a Brazilian corporate that sells stuff in dollars accumulates these dollars, right? And it needs to invest them in something. Today, they buy government bonds, they buy treasuries. If they would use, let's say, the euro or the Chinese renminbi, do you think a Brazilian corporate would be happy to invest their hard-earned Chinese renminbi by selling their commodities into Chinese renminbi assets? You could get your assets locked up in China really quickly. So it's a lack of alternatives. And it's otherwise a very painful process that would take away the dollar from its dollar dominance. It will happen, but it will happen through a pretty painful process.
Right. And I think that's important to clarify. It's not a fairy tale that you don't think it will happen, but it's a fairy tale to think it will be orderly. How far out are we from that reality? And I bring up a recent interview I had with Kevin O'Leary, who thinks otherwise. He says he keeps hearing about de-dollarization since 1966. For him, it's just not going to happen because he says, if you look at who's dumping dollars, Brazil, Venezuela, Russia, he says, who cares? There are countries that don't count.
Well, the thing is, you always start from countries that don't count, and then you sum up to a bunch of countries that don't count, but put them up together, they all count when you consider them as a sum, right? And the dollar has slowly but surely lost a bit of its dominance over the last 20 years, Daniela. So we have gone from 70-80% of dollar dominance overall to maybe 60-65%. This might seem insignificant, but I think it's a trend building up. Now, the question is, what replaces the dollar-based system? That's the real question, right? Because we can keep screaming about de-dollarization, but what is the new system? Well, let me give you a hint. It's not a system based on a bunch of currencies that go together and are commodity-backed on all these fancy things. I think the most likely alternative is a gold-based system once again. And you now will be like, Alf, again, gold? That's like a thing of 1,000 years ago. Okay, let me ask you something. During this de-dollarization process we have seen slowly but surely building over the last few years and few decades, do you know what is the asset that central banks around the world and governments are still accumulating and buying at a pretty rapid pace? It's gold. It is gold. And why? Gold already sits in the system. It already sits on the balance sheet of governments, central banks, exactly these so-called small countries that might want to hope to get away from the dollar. On top of it, gold has already served this very role of being the anchor, the real asset that everybody trusts to be basically the pin around the global monetary system. It has already done so, and quite successfully, multiple of times in history in the past. That means it is the most likely, although not the most fancy, but the most likely hard asset to take that role again.
And if it is a gold-backed system, and of course these are all just theories, but you're right, central banks have bought gold at historic rates here. China keeps adding, but who would be the country behind it? Is it the BRICS altogether with a gold-backed system? Is it China alone? What does it look like for you?
Well, obviously, again, this transition, Daniela, will not be a smooth one. I mean, if you're moving away from dollar dominance to a system based on gold, you're basically deleveraging the system as we know it. When you do a gold-based system, that is not anymore at the epicenter of the system, because if you do that, you're basically increasing leverage, you're creating fiat dollars. But if gold is there to serve as an anchor, at some point you can't do that anymore, because you can always convert your dollars at a fixed price to gold. If there are too many dollars, if there is too much debt, the system doesn't work anymore. A transition away from a debt-based system denominated in dollars to a gold system is not an easy, smooth transition. It basically comes with geopolitical tension. I mean, wars, tectonic shifts, nothing we hope for, let's say, as humanity. So people that are talking about de-dollarization are basically talking about deleveraging, pain, harsh situations. It's not a smooth transition. And basically, you're also talking about transitioning of global powers. This is not something that happens smoothly overnight. It takes quite some pain to move away from a dollar-based system to a gold-based system.
Well, it's interesting. If you read a recent talk from Christine Lagarde, she hints to the fact that geopolitical powers were moving towards just a two-power system here, right, of U.S., China. So are you saying it could be war of U.S. versus China to get to that system?
Yes, of course, nobody hopes for anything like that, but there have been increasing tensions in Asia, especially when you talk about the Chinese and the Taiwanese situation. I mean, if you want to transition from the dollar-based system, which today basically includes a bunch of developed market economies too, that's Europe, that's the UK, that's Japan, to another system that is not based on that anymore. It's not based on leverage, it's not based on debt, but it's based on hard assets. Then you're really talking about a bipolar world, right? You're talking about a switch of global powers. And that other block, yes, Daniela, that's basically China, India, Russia, Brazil, all emerging markets that have not based their economy necessarily on debt and leverage. They rather base their economies on hard assets. So they have a vested incentive scheme in having a hard asset like gold being the anchor for the global economy.
So I'm assuming this is the reason that you think China has been quietly and silently adding gold to its reserves, and every few months they share, oh, we bought, X amount. But why is it not crypto for you?
Well, the problem with this transition is that you need something that people will immediately trust. Daniela. So if you're trying to anchor, if you're trying to create a new monetary system, if you're trying to deleverage the existing one, it's a painful process. So you need something that has a track record in being a hard asset, a store of value for people, something that has already worked in the past. Gold has. Digital assets don't have the track record yet. So they might participate maybe in this transition, but I think the asset of choice will remain gold.
Yeah. I think it's interesting because you've been on in the past, you were never uber bullish gold. Has that changed for you now?
Well, look, here we're talking about secular trends, right? We're talking about de-dollarization and big secular trends. This can take decades, right, Daniela? While normally when we talk about gold, we talk about it in the context of short-term asset allocation, right? Is it like something you want to have now in 3 months or in 6 months? I always think having gold in your portfolio 5-10% allocation is a great idea. Why? Exactly to hedge against this risk. We always talk about de-dollarization. We never know when it's going to happen, right?
Let me ask you this, because yes, we have the discussion of de-dollarization, but we also have the discussion of central bank digital currencies, of currencies going digital. So it's really two different topics here, but at one point, do they coincide?
Okay, look. Central bank digital currencies. We need to talk about money for a second, because in our fiat-based system, you basically have two forms of money. You have a deposit at a commercial bank, which is how most of us keep most of our money today. Is it, Daniela? We have money deposited at a bank account in a commercial bank, right? Anything above the government insured limits, which is 100,000 in Europe and 250,000 in the US, is at risk of default, basically. It's a risk that you're running on the bank. And now we have seen some stress from that perspective, right? And the US had to guarantee or come in and say, hey, look, guys, you're not going to lose your money if it's deposited at the bank. But it tells us about how the system works. The money we use is basically a liability of a commercial bank. That's what it is. The second way to keep money, which is a safer one, is to buy T-bills, short-dated government bonds. Why? Because that is basically money issued by the government. It's a much lower risk than depositing your money at a bank. Nevertheless, it's not a sound, uncompromisable form of money. This is because this is how the fiat system is built, right? So central banks now are coming up and saying, hey, maybe we can come up with another form of money. Instead of your money being a liability of the commercial bank or a liability of the government, why don't we make your money a liability of the central bank in the first place, right? You probably will feel safer this way.
Exactly.
And that's what, they're trying to do with it. But it also comes with a layer of control, a layer of targeting, let's say, several policies that today can only be one interest rate policy. In the future, they could be three. They could say, hey, everybody with an account at the central bank above or below this amount will get a certain interest rate. Anybody else will get another interest rate. So it generally basically adds another layer of interconnection and control within the fiat system. It is nothing markedly different than what we have today. It's just another version of money within a fiat system.
And speaking about the Fed, we're obviously speaking ahead of the big May meeting. Alf, curious to get your thoughts. 25 basis points is what's anticipated, expected here. Your take on what the Fed will do next.
So, Daniel, I wrote a piece for the Macro Compass clients a week ago where I said, look, the Fed is one and done in May. So I expect them to hike 25 basis points for the last time in May. I expect them to be done with it. Fed funds will be just a bit above 5% at that point. And the reason why the Fed will be done is the following. In the past, every time the Fed had to slow down an economy and had to slow down inflation, they always raised Fed funds rate about 150 basis points above core inflation. By the summer, core inflation should be around 4% annualized levels, still increasing 4% year over year, but Fed funds will be at 5 or a bit above that. So basically, Fed funds in real terms after inflation will be finally positive. In the past, every time we have reached that level, the economy couldn't take it anymore, Daniela. Basically, real interest rates were positive, borrowing costs were higher, conditions were tighter, and at some point the economy can't take it anymore. And yes, you manage to slow down inflation, but because you're basically driving the economy in a recession. That's how you get there.
Bingo. And talking about recession, why can't the Fed just be more transparent on this topic? I mean, I was rereading the recent minutes, and if you read through the tea leaves, they're saying, yeah, it's coming, but can't they just come out and say we need to prepare for this?
Let me go back and bring the audience back to
08?
March 2008. March
Yes.
2008. But I can also talk about March 2001. It's the same story. March 2008, during the Fed minutes of the meeting they had in March, they were debating, Daniela, whether we were looking at a mild recession.
Right.
What? We were in the midst of the mother of all great financial crises, basically, that we had in the recent past. Now, that tells you something, right? It tells you that the Fed is not the entity to follow when it comes to forecasting where are we in the macro cycle, right? That's because any policymaker does not want to volunteer to be the one that caused a recession. So they're never going to call for one, Daniela.
Right.
They're never going to call for one.
But so if the Fed, going back to your point, if they do stop raising rates and we're stuck at this inflation level, is it a period of stagflation for you? A long period of stagflation?
No, the way I see this is a bit different. So there is a cycle and there is a trend in inflation. When it comes to the cycle, people are telling me, Alf, inflation will never go back to 2%. Well, I can tell you inflation will go even below that if we go in a recession. And there is data that speaks about that. Over the last 100 years, any recession in the US managed to bring down inflation by 7 percentage points, Daniela, 7 percentage points. We start as we speak with inflation around 5-6% as we speak today. If we enter a recession today, the average recession historically would basically bring inflation to 0% or even will bring us through a short period of disinflation, of deflation even. That's what history says. Does that mean that inflation will stay there forever? No. That's the trend. One thing is the cycle where a recession brings inflation down really rapidly. The other thing is, have we gone through some transformation after the pandemic, which will drive inflation structurally to be higher than the 1.5% levels we have seen for the last decade? Yes, that might be the case. The Chinese population is not expanding anymore. We don't get any cheap workforce anymore over the next few decades, Daniela. I mean, the Chinese workforce will shrink by almost 40% over the next few decades.
Good point.
You don't get this cheap labor. You don't get the cheap labor anymore. Cheap commodities. Let's talk about that. We just talked about the bipolar world. So all this on-time, seamless global supply chains, cheap energy, again, a topic to discuss. So we have ways to think why inflation could be structurally higher, but it takes decades for that theme to play out. Trust me, on the cycle, if you get a recession, inflation will not only slow to 2%, but even below that.
So Alf, given all this information, what are you advising investors? What is one to do given what we're facing right now?
Well, the first thing I'm going to say is, yes, we're going to get a Fed pivot. I expect the Federal Reserve to slash interest rates to 0% somewhere in 2024 because we're going to get a recession. So last time the Fed did that and slashed the interest rates from 5% back to 1% was in 2001, Daniela, when the Fed did a massive pivot from 5% to 1% in 12 to 15 months. The S&P 500 in 2001, despite this massive Fed pivot, lost 12% again. Gold held its ground, the dollar held its ground, but equities actually lost another 12% despite a massive Fed pivot. So what I want to say to investors with this is, don't play a hero. This is not the time of the cycle where to be very aggressive. It's the time of the cycle where to think about defensive assets, bonds, gold. That's what you want to look at this point of the cycle, not trying to YOLO into stocks and high aggressive bets because the Fed is pivoting. Ask yourself, why is the Fed pivoting?
You mean you don't think Tesla's going to go to 2,000?
No, I don't think so. Maybe with auto robots somewhere in the next decade, but not in this cycle. In this cycle, unprofitable companies during a recession will be punished.
Alf Picatiello, it's always a great catching up with you. You can follow him at themacrocompass.com. Thank you so much.
Thanks, Daniela, for having me.
By the way, how's the pizza making going? I love following you on Twitter for that aspect mostly.
Well, I have to say that I have a Neapolitan wife, which is very picky when it comes to taste. So my judge says it's going okay, but I will be sharing the
Okay,
results with all of you guys, so you can
please.
test at least visually what the level is.
When she gives a 10 on 10, I want to be the first to hear about it. Al, thank you so much.
Thanks, Daniela.
And thank you all for watching. We'll have more great content coming your way, so be sure to stay tuned to the Daniela Cambone Show and sign up at danielacambone.com for more great content. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.